Okay, so now the meetup is recording, and today I'm going to go over one strategy. Some of you have seen it before, but it is one of our favorite strategies. But before we do that, I always get asked to take a look at the big picture of the market to see what's going on. So I'm going to go switch charts here and switch the view and pull up a chart of the S&P. All right, this is a monthly chart of the S&P 500, which you're seeing right now. Back in March, this is the March candle. This is the monthly candle. Each candle is 1 month. Here's where, as the market came down, there's doom and gloom. Everything you see on TV tells you the market's going to go down, drop, and they try to scare you. And I'm not sure why they always do that, but I guess that's their job, is to scare people as much as possible. And then a day later, they'll stop when the market goes back up. But so here's a monthly chart of the S&P. This blue line is a 40-period moving average. And it's just showing basically long-term support. This 40-period moving average has been in place ever since the end of the drop in 2009. So ever since, here was the bottom of the market in 2000. And so here is 2012. And here's 2009, the bottom, after the big drop in 2008. And then it came up above the 40 and it stayed there basically since then, okay? It'll dip below the 40 once in a while, every couple of years, and then close back up above the 40, keep going, and that's this constant uptrend. Dip below the 40, back above into the uptrend. So this has been a massive uptrend. Dip below the 40, right back up into the massive uptrend. Dip below the 40, right back up into the massive uptrend. Here we were in March. Hit the 40 in April, came down below the 40, closed back above the 40, back into the massive uptrend. Okay. And here we are right now so this is May, and now we are in June, right? And we're basically in a rally mode with lots of buy signals going on. We probably wouldn't have to be concerned about this massive drop unless we saw 2 consecutive lower closes below this monthly 40. Then we'll probably pull back at least to previous support levels. But that hasn't happened in a couple of years. We pull back to the 40 every couple of years and then take off again. I asked the question, why do you use the 40? Because we learned some strategies way back when, how to look at longer term viewpoint of the market from an investment point of view as opposed to a trading point of view. So if you're looking at the market from an investing point of view, you don't look at daily charts. That would be silly. That's not investing. So we look at monthly charts from an investor point of view, the big picture. And when you look at the big picture, it becomes a lot simpler. There's very little volatility when you look at the big picture. It goes down, then up. It goes down, then up. And it goes down, then up. There's no noise, okay? So that's why we look at the bigger picture to see a calm picture of what's actually going on. And no big deal, no current worries to think about. We're in this massive uptrend. Can it pull back? Of course it will. It will eventually drop it to some lower levels and eventually back up again. But right now, it hasn't happened. Our uptrend is in place. In the summertime months, the market tends to go more choppy and sideways. This is regular seasonal pattern. Summertime months, market tends to go more sideways and choppy. And we're seeing exactly that right now. It's just sideways and choppy, but still with a big uptrend is still in place. Okay, we haven't had any major closes. So when the market came all the way down here, people are stressing, media people are saying it's gonna keep dropping forever. No. And I told someone a week before the end of May, I expect that last week for the market to rally. back up above these levels, and it did, because I was expecting a close back above, and it did. All right, and then we got a bunch of buy signals that came in after that on that rally also from the futures. All right, so now I'm going to switch back to the daily chart. I'm going to take a look at one of the strategies. And in the chat window, you're going to see Becky posted the link for the handout, and also trade history is on that link also. So if we go to, I'll put another copy there. And this is going to, if you look at in the chat window, that's where the handouts are and all the spreadsheets and historical trades. Does the 40 SMA or EMA correspond to any Fibonacci level? No, it's just a moving average of price. That's it. If you want to do Fibonacci, that you have to do with certain highs and lows. Fibonacci, we don't specifically use Fibonacci because it's too subjective, where you just happen to want to draw your line. But we do use retraces, but in a more 100% objective way. There's a way we do that, not specifically Fibonacci, but the end result basically becomes the same. Well, we don't specifically do Fibonacci because 10 different people drawing Fibonacci lines will draw them in 10 different places because they all see things differently. So we stopped doing Fibonacci because it's too subjective. But we do retraces, but in a very definitive way, where if we showed this method to 100 different people, 100 different people will draw the lines exactly the same way. And we do that in our future strategies and some of the ETF option strategies, but definitely in the future strategies doing retraces. But yeah, SMA is just an SMA, it's just a moving average of price. Fibonacci is going to be a whole different thing. All right, so I'm going to switch charts and then go back to the trading plan, sample trading plan. Okay, so here is the daily chart of the S&P. And here is the rally we had off the lows. And we had a bunch of buy signals on the futures as we rallied. And we've had a couple of buy signals on the ETF options also that are currently in play. So that's why I'm expecting those high probability trade with options to still continue going higher into June, because we already had buy signals, right? Okay, so this strategy, I'm going to go to the trading plan real quick, show you what it is, and then go back to the chart, and then spend most of our time on the charts. If there's any questions you have, don't raise your hand, I won't see that. Unmute, ask the question, or type it into the chat window and I'll see it eventually. But don't raise your hand, I'll never see a raised hand. All right. So the trading plan for this strategy, this is a trimmed down trading plan. The ones we give to coaching students will be a lot more detailed. The first part of a trading plan is usually it tells you when to not trade. When to not trade is really important also. Also, the full trading plan will tell you the specific settings for all the indicators and a lot more details for each step. So it's basically a checklist of what you're looking for to set up, the trigger, the criteria to confirm what you have is good. And what I go over with you in detail is the trade management. That's when I meet with you one-on-one. I go over that with you in detail. This last part is what takes many hours working with me, is how to manage your positions, the details. That's one-on-one. You can't explain it in 2 sentences. It's literally, I sit with you and we go through it, especially with options, since there's so many variables with options, since they're not linear. So a lot more details like pricing, what's too expensive, what's not too expensive, so on and so forth. What time to get in, what's good, what's bad, the stats, win-loss percentages, and how to all balance all that out. That's all done during the one-on-one coaching sessions for trade management. All right, so how this trading plans are set up and how we go about doing things is a setup, trigger, and trade management. This is terminology borrowed from Jake Bernstein. a setup is visually what you look for. You look for, and our setups is usually two lines crossing each other. A hook, meaning an indicator goes down, then hooks upward, or goes up and then hooks downward, or a change in color. Those are our setups. Is literally that, just a visual. Unless you see one of those visuals happen, two lines crossing, a hook up or hook down, there's nothing, you don't need to spend any more time on that. Okay, just move on, next one, and you can do a review really fast to look for valid things to evaluate. If you don't see a setup, next. No setup, next one you see a cross, okay, stop and look at it. Okay, the trigger is a confirmation. It's usually looking at an indicator or something with price. And it's a secondary confirmation of the setup. So the setup is what you look for. Then the steps in the trigger will verify, will give me, if all the setup criteria is valid and the trigger criteria is valid, then when those are all in place, I know I have a statistical expectation that if I were to, let's say, buy call options, then this ETF will move up a certain magnitude within a given amount of time, a certain percentage of the time. We don't do any trades where we don't expect the first profit objective to be reached 84% of the time. And we average 85 to 87% wins in any given year or any given several month period. This year so far in the first 5 months, we're averaging 85% winning trades on options. Okay. I have a question. Do you use only index ETFs or individual stocks? No individual stocks. Individual stocks, absolutely not, because of implied volatility. The pricing is ridiculous. And if you're just buying calls and puts in a day or two, the volatility crush can just kill all your option pricing. You don't have the implied volatility issues with the ETF, since the ETF has dozens and dozens of stocks in it. There's no one stock that's going to, implied volatility will hurt you. So with the ETFs, we can buy the ETF and not be killed by just time decay and volatility crush. So we can buy the ETFs and have just, buy the option, no spreads, absolutely no spreads at all. This is buying calls and puts, and we can have an expectation of being profitable without a whole lot, without making adjustments, no putting more money into trades gone bad, no adjustments. We don't do any of that stuff. That's how we learned it initially. And if you are extremely, extremely good at math and you have a boatload of money, then spread trading might be great for you. And been there, done that, got really, really good at it to a point where I didn't even have a losing trade. But that also required putting more money into trades gone bad and putting more money into the trades gone bad. And then when the adjustments go bad, you have to put more money to adjust the adjustments. And that is not something I wanted to do if I wanted to be able to trade for a living and not have a regular job. I don't have this infinite supply of money to keep putting good money behind bad money. It's so much easier just buying calls and puts if you have the right methodology and if you've been around the right people to learn those methodologies from. It wasn't until I started surrounding myself, and Becky also, with people who traded their own real money, not a trading school, people who traded their own real capital directionally with either futures or calls and puts. That's when we learned how to really trade directionally and manage positions and allocate risk so that we never, ever, ever can have a big loss, because every trade, no trade we place will risk more than about 2% of our account on one trade. So if one trade goes bad and you have a loss, that's 2% of the account. You can make that back. If you start risking 10, 20, 30, 40% of your account on one trade, what if it goes bad? You're going to lose a big chunk of your account and you can't make that back. And if you have to make adjustments, where are you going to get the money from to adjust it? Because you have to put an equal or greater amount of money for one adjustment. And you may have to make 2, 3, or 4 adjustments if you're doing spreads. So it's not, so to be efficient, we just buy calls and puts And I'm going to go through some numbers that one of the people I was coaching shared with us several years ago, because he was so proud of his trading. He actually showed us his real trading account following the strategy rules for over 7 months of trading. And we'll show you that a little bit later on, so you get a feel for the numbers involved when you follow a plan and follow a set of rules. This is, does a strategy keep you out during earnings? This is not stock trading. When you look at the chart, I'm going to put, so I'm going to go back over to, when you look at a chart of the S&P, there's no earnings there. It's just the S&P. There are 500 stocks in the S&P. One company, it makes no difference. One company, it makes no difference, since we don't trade any individual stocks, just ETFs. The NASDAQ 100, there are 100 stocks and there are no one earnings. And anyone who's afraid of earnings, it means you don't really know what you're doing. Earnings is the biggest market mover on a particular stock, and there are ways to trade earnings and to profit off of that. So to be afraid of earnings means you don't know how to trade earnings, and there are ways to do that, many ways to do that. We used to do that with options, and we do that sometimes in October. October is a special reason for October, but only October. So earnings is making stocks move. During earnings season, when the earnings numbers start to come out, we look forward to that, because now we know the markets are going to move. S&P is going to move, all the other markets are going to move. We don't care if it moves up or down, as long as it's moving. So as long as the market's moving, we're happy with that, because the movement is what creates opportunities. We're directional traders. We need buy signals and sell signals. So we don't care if it goes up or down, as long as we get our buy and sell signals. That's all we care about. And the more volatility we get in either direction, great. But that's how we capitalize on earnings, because it's driving the markets and making the markets move one way or the other. All right. So trading plan, we're looking for a crossover of the Donchian mean line. And this is easy to show you on the chart, then you can reference this later on. So I'm going to go back to the chart. I'm going to show you what this strategy is. Some of you have seen it, but some of you are brand new to this. All right. So here we are looking at the chart of the S&P 500, the SPY, this ETF. So the orange line, this is the Donchian mean line from Donchian indicator. The Donchian Channel indicator consists of 3 lines, an upper, a lower, and a middle line, which is the mean line. I'm not showing the upper and lower because we don't use it. So I don't want extra lines on a chart. We're just using the mean line only. The blue line is a 40-period simple moving average. So all that is 40-period simple moving average on a daily chart. You find we have the same moving average on all of our charts, pretty much, the 40. Whether daily, weekly, or monthly, the 40 is on there. And some people have asked why I use the 40. There's a gentleman named Oliver Velez. Did a lot of workshops or webinars with him at Traders Expo, met him live, did workshops with him there, all free. Got his videos, all free, webinars, everything, all the handouts. We have a ton of information from Oliver Velez and his strategies. And the one thing that was consistent on all of his charts and all of his strategies was the 40-period simple moving average. And because of that, we started looking at the 40-period simple moving average and found it really worked well for us in what we were doing in order to qualify trends and certain levels in the market. So that's why we kept the 40-period simple moving average in pretty much most of our charts and strategies, because of what we learned from Oliver. And so that's the reason you're going to see the 40 on every chart we have, almost. All right. So what are we looking for? And this dotted line is the Bollinger Band, just the upper Bollinger Band. We don't show the lower or the middle because we're not using the lower or the middle. So we don't want extra lines on the chart. So we got an upper Bollinger Band, Donchian mean line, and a 40-period simple moving average. That's all that's being used for this particular strategy. All right, so what we look for is the Donchian mean line to cross over the 40-period simple moving average. This was the S&P on October 26, 2021. All right. It crossed over and it has to close below the Bollinger Band, and it closed below the Bollinger Band. If you're not familiar, this is NinjaTrader software which we're using. And the data box, NinjaTrader is free to use for anyone who wants to use it. NinjaTrader is free. This analysis can also be done on Thinkorswim or other platforms, but we use NinjaTrader and Thinkorswim. Those are the two platforms we use for ETFs and options. I like the NinjaTrader platform because it's easy to use, and we can do everything on here. But if you have Thinkorswim, that's great too, or other platforms that have the indicators, that's fine also. The Donchian is available on, I think, most platforms. And the data box here, you'll find the data box. The colors on data box will match the indicator color. So that's how you can just look. So if I say look over here to the on the data box, it'll just match the numbers and the colors, open, high, low, and close, and indicator values will match wherever I am on the chart. All right. So crossover, orange line crosses the blue line. And now on our stat sheet, we know that when we have this set up and a trigger you'll see on the trading plans, there's a number of days that this orange line had to be underneath the blue line. That's in our detailed trading plan. And the single day must close below the Bollinger Band, and it did. All right, so it closes below the Bollinger Band. All criteria is met. And if you look at our stat sheet, it'll say that whenever this grouping of scenarios happen, whenever I get this crossover, a close below the Bollinger Band, and a number of days below the orange line, below the blue line is valid, I have an 89% chance, 89% of the time when this happens on SPY, SPY will go higher by at least one ATR within the next 2 months. Actually, within the next 1 month, okay? Or one expiration cycle. What I'm calling one expiration cycle. Expiration, the only expiration, option expiration we care about is the third Friday of the month. Not all those fancy expiration options expirations that have been created over the last 15 years. They didn't, all the ones where you have things expiring weekly and every day and every couple of weeks. Those did not exist in 2005, okay? Those got created over the years. The one expiration that's been consistent for decades is the third option expiring the third Friday of the month. That is the only option expiration we care about. Expirations the third Friday of each month. So when I say one expiration cycle, one full expiration cycle is the Monday after expiration Friday until the following month's expiration Friday. That's one full cycle. So for anyone listening, if I have a trade valid on 10/26/21, anyone with a calendar, what would in which month would be one full expiration cycle? Type it in or say something. If the trade's valid on 10/26/21, in what month option would I be buying for one full expiration cycle? What month would that be for one full expiration cycle? Someone please type it in or unmute and say something. Okay, Scott says November. All right. And no, it would not be November. It would be December, because in October, 10, 11, 12, 13, 14, 15. In October, this day is after the next cycle starts on the Monday. This cycle starts from the Monday after expiration until expiration Friday in November. So this would be after the start of the current cycle. This day would be after the start of the current cycle. So it's not one full cycle. You need one full complete expiration cycle, not a partial. So I'd be getting December options, but if I go to November, that would be a partial cycle, not one full cycle. So I'd have to get November options for one full cycle. Excuse me, December options for one full cycle, no partial. So if one full cycle is starting the Monday after expiration Friday until the following month's expiration Friday, that would be one full cycle, right? Does that clarify it, Scott? Or do I need to pull some calendars up so that you can see it? Okay, so that's real important. So this is how we determine how much time we need in the option life. The more months you go out, the more expensive the options will be. So our sweet spot is really about 2 months. You may end up having to go 3 months. That's okay too. If you find yourself having to go more than 3 months to find an option, you're paying way too much for the option. It's just too expensive. You're not going to get, even if your options hit the first profit target within the given amount of time, you might be hit with time decay, or your upfront cost was so high, your percentage return is really extremely minimal. It might still be profitable, even a small loss, but you're tying up money in a trade where the upfront cost is just too high. So just buying calls and puts, you just can't randomly buy calls and puts because time decay will kill you. So this is how we determine how much time came from placing thousands of trades and figuring it out, basically. So we took our losses, we took our wins, but we learned, and this is based upon real life trading. And we've been trading the same way since like 2007 or 2008 with options, the exact same way. We know how much time is needed. And how we determine how much time was something we actually had learned from Daniel Gramza. He taught us how to do the evaluation to determine how much time is needed. And last time I saw him was probably about 2.5 years ago. And I was talking to him about it, and I told him I had done exactly what he had instructed, and he was totally shocked, because how he taught people to do it requires so much work, so much time and effort. He didn't think anyone would ever do it. And I told him I did it, and it's worked really, really well. And from him way back when, but he never thought anyone ever listened to him, because to try to do it the way he said to do it requires a massive amount of time and effort. But myself and Becky, we put in the massive time and effort. We got all the data. We know it works, and we know how much time is needed. We know how much time is needed to get the results we want. We know our option pricing. So we learned from someone who we saw doing it with their own real money, and we did what they did, and it works. And that is really key, is to finding people who do it with their own real money, not just running a trading school, okay, with a bunch of people on a webinar. Okay, so that's why I do everything one-on-one when I'm working with people, because it's not a lecture. This is a lecture. And working with one-on-one, I guide people. So they have to figure stuff out. I don't do work for them. They have to be able to do the work. I just guide people as they do the work, so that they can figure it out, because I'm not going to be living with them. I'm not over their shoulder from day to day. So everyone has to know how to do their own work. This is a business, and you have to be able to run your own business from day to day. And you can't rely on someone else to do it for you. So that's why I make sure everyone learns how to do this themselves. All right, going back to the chart here. ATR, take a look at the data box. ATR this day is 3.61. If you don't know what ATR means, it's average true range. And we use the 5-period ATR. And what that generally says is that on every 5 days, the SPY is moving $3.61 on average. Okay, that's what it says. So this is how we're going to determine what our profit target is, using the ATR. So we know we're buying an option that expires in December. Now we know how big our profit target is, $3.61. Okay, And that'll all be on a stat sheet that we hand out to people I'm coaching. So how do we trade this? We can get in anytime after the next day at or below the open price of the ETF the next day. So the very next day, the ETF opened at $456.45, $465, $456.45 was the open price the next day. I need someone to have a calculator out because you're going to calculate a number and type it in to the data box. So someone get ready to calculate. What is $3.61? What is $3.61 added to $456.45? So what is $3.61 added to 456.45? The open price. 456.45 is the open price added to $3.61. What is that value? Someone please type it in. We'll go on. Okay. 460.06. All right. So now we know our first profit objective. This is how we know how to fill out. Now we know how to fill out our order form out. All right. The next day, sometime after the open, when the market is at or below the open price, we're going to buy December call options, which are one strike in the money call options for December. Whatever the price of the option is, and we have criteria to know if it's too expensive, but we're going to buy that call option, the first strike in the money, and that option will now be sitting in our account. After we buy the option, let's say we're getting two contracts, we're buying two contracts. We now have two contracts of SPY expiring the third Friday in December. We're going to put in an exit order to sell. Let's get all out of the first target. Sell two contracts when SPY goes up to $460.06. So that day you bought your call options, and now you're going to put in a good till cancel order to sell your options when SPY, it's a conditional order, when SPY goes above 460.06. Okay. Let's see when it got there. The high the next day is 458.40. The high the next day is 459.56. The high the next day is 460.70. On this day, 3 days later, or 4 days later, your order is filled. At the first target, you get your money and you're happy. With a quick move like that, it's going to be between a 20 and 30-something% return on your money in about 3 days, in that range, with that type of quick move. Okay. Now, if you want looking to make more profits off this up move, if you had two contracts, you can sell one contract at the first target, lock that profit in, and then move your stop loss up on the remaining contracts above what you paid and just trail the stop. So as there continues to be more profit in the option, you're just trailing the stop up. So if you pay, let's say you paid $5 for the option, and at the first target, they're worth $6. Okay. That's like a 20% return somewhere there. And you sell one of the two contracts for $6, you make $100, let's just say that. And you move the stop loss up on the remaining contract. You paid $5, you can put your stop loss at like $5.25. That means you're protecting 25% of your existing profit. And we have ways of doing that for slippage and everything else too. So I work with you on that percentage, and what percentage you protect depends on your financial situation and your personality. How much money are you willing to give back to see about getting more? This is a type of trade where you can quickly double the value of the second option. Okay, so a quick moving up move like this, especially with a couple of gaps in here, you can quickly double the price of the option in a couple of days and for that second contract or second half of the trade. All right. Someone's commenting. Michael. Michael, you unmuted. You saying something? Okay.
No, sorry.
All right. So those are your choices when you are trading it live. You can either exit the whole position, grab your money and run, or you can trail stops on the remaining contracts to capture more profits. And we go through how to do that. Your initial order for the first target is based on the price of the ETF, reaching a certain value, reaching a certain price. After the first target, all trade management is based on the option. The ETF is no longer considered. It is now all stops and targets are based on option pricing after the first target. I've had people wonder, well, how do we know what the option price will be if this ETF price is good? You don't. That's why we don't care what the ETF price is after the first target. It's just purely option management, which makes it actually pretty easy. Any questions so far? We go through a lot of stuff. So, and I am recording this, and I'll make the recording available a little bit later on, so you can play it back at your convenience also. Any questions so far? Just go ahead, unmute or type it in. We're doing a lot of stuff here. You know, realize it. You may not realize that it's a lot, but it is a lot, especially if you're kind of new. Okay. So this scenario happens like all the time. Okay. Here's a crossover here. ATR this day, you would think, oh, it goes down, it's a loss. No. ATR that day is $6.07. Entry price, you need someone with the calculator again. If I have a target of $6.07, the open price the next day is $465.23. What is $6.07 added to 465.23? $6.07 added to 465.23 is what? $6.07 added to 465.23. What's that number? 471.30. Okay. That first day, you would be buying the call options at or below the open price. So that day, the market opened at 465.23 and then it went down. So during all the time the market was at or below the open price is your time to buy your call options. And that day it went as high as 469.85. And the next day it went up to 473.20. So the next day it actually opened at 471.59 on the gap. So gaps are nice. You get an extra money made from volatility. So this is the kind of quick trade where you're going to get a 25 to 40% return in that range, depending on what you paid, but in that neighborhood for the option. Quick profit. If you've got remaining contracts, you move your stop up in those and you'll be out of that trade the next day when it goes down. Hit your stop and you lock in whatever profit you have there and move on, or you grabbed all your money at the first target and you were out. It's really, is it that simple? Yes, it is. But you have to treat it like a business, show up each day, manage your positions, adjust your stops if needed, and take care of your business. If you lose every penny of your life savings trading, nobody cares. Literally, nobody cares if you lose every penny you have trading, because people will tell you, well, you're just gambling, you just lost it all, so that's your problem. That's what people think. It's not gambling if you have a plan and you know what you're doing. But no one, when it comes to trading, literally no one cares if you lose all your money except for you. So you have to be the one responsible for showing up every day, managing your positions. If you're trading a strategy that requires you to put stops in a timely manner after your position is filled, excuse me, you put your stops in. You do what you got to do each day. It's a job, it's a business. You got to show up. No one will do it for you. It's a sole proprietorship. No one else will help you. If you're trading with learning from me, we have a group. We have a Facebook group. You can ask questions, you can get help, you can communicate with other people. So there's more than with me, have other people respond to you, also help you with things. So it helps to have other people around you doing the same strategies. You don't know if you're doing something on your own, you have no idea if the charts are even correct. People always assume the charts they're looking at are right. No, they're not. Sometimes they'll be totally wrong and you will never know. I have people, when I'm looking at something, I run a scan, I see this valid, someone else emailed and said, no, it's not valid. I'm like, yes, it is valid. Oh, no, it is. And then we ask 2 or 3 people and they're all getting different results. Then we do a data update and then they're all the same. But some people had bad data. They didn't realize it until they communicated with other people and different people were getting different results with the same exact thing. Bad data happens all the time. We just don't know about it unless you are communicating with other people who identify it. There is some bad data on these, on all the release charts in the world. There's bad data on S&P, NASDAQ, Dow. No one would know. How I know is because we had several people that had a trade that did not execute. And we saw the charts and we like, this trade's of execute. I'm like, why didn't it execute? We called the broker, we called Thinkorswim. They looked at it and said, and acknowledged that their daily charts were wrong. The daily charts were wrong. They looked at it intraday and they saw the markets never actually got to the prices that are shown on the daily charts. And that will never be corrected. It will never, ever be corrected. Those daily charts will remain wrong for all eternity. And people will do back testing and they'll factor that into wrong data into their back tests, and it's going to propagate forever. So there's always bad data on charts. You'll never know. We had people who found whole weeks missing. Trades on Saturdays. We don't trade on Saturdays. There is no trading on Saturdays, but the charts had data on Saturdays. And for those of you who don't know it, if you use Thinkorswim data, and particularly futures or Forex, you know, they didn't always have futures and Forex trading. There was a point in 2000 something where they purchased data, they acquired data, and that data basically came from Russia, from the, I think it was the BATS. And that data, it wasn't adjusted time-wise to reflect US trading hours. As a result, some of the data they're using on the charts still show up as happening on Saturday because that data was, the time wasn't adjusted for US market hours. So, but you would never know that unless you look at the charts every day to see there's something wrong here. But we look at the charts every single day. We do testing every day. So we see, and we have 3 or 4 different platforms we use. And sometimes we'll see differences between 3 or 4 different platforms. And I was like, what's going on here? And that's when we find out certain ones had errors. And then we talk to them, they acknowledge it, yep. And it told us how it can be fixed on our end, so we can fix it if we want to. But yeah, you have to know that you're on your own. No one's going to tell you, but if you're with a group, it helps to be with a group of people doing the same thing you're doing. Again, this strategy happens all the time, all the time, all the time. Bullish cross up, buy your call options. Bullish cross up, buy your call options. This one didn't have enough days below, so they're not valid. Bullish cross up, goes against you for a couple of weeks, then cha-ching, gap, 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 gap. This was 2020, buy your call options. And bullish cross up, buy your call options. And I can pull up any of the ETFs and it's the same type of scenario. Lately, I think the big movers lately has been oil and energy, XOP. Bullish cross up. Bullish cross up. And that scenario happens all the time. Bullish cross up, orange line above the blue line. Not a cross down, there's not a sell deal. Bullish cross up. bullish cross up, so on and so forth. So, and I know we had some energy ones. XLE, I think, came up valid recently. Here it is, XLE on May 13th, bullish cross up. That was a nice big mover. So we do I personally do a combination of ETF options and futures. I like that combination. I saved the futures for the indices, Dow, S&P, NASDAQ, and Russell 2000, plus the currencies. Like we trade the Euro, Aussie, British pound, Canadian dollar, and Swiss franc with futures. With ETF options, I like to trade everything else with ETF options that's not the Dow, NASDAQ, S&P, or Russell. So biotech, oil, energy, silver, gold. And I'll show you a list of what we trade in a moment. But so far, do we have any questions? Anything at all whatsoever? It was a lot of stuff, and that's when you get a good idea for how we approach trading and how we profit. Okay, I'm going to, where were the stats? Were the stats poor for shorting? You have all the stats, Leo, right? Most of the trades happen on the long side, but the stats for the shorts, you have them. It's the same. They're all 84 to 90 something percent. There's no real difference. There's no real difference for long or short. What you'll see sometimes is some of the shorts will go against you a little more, but when they start dropping, the volatility juices up those option prices. So you might get a short because, you know, we sell market tops. So when we sell market tops, sometimes in an uptrend, that market's going to keep going higher, but eventually when the markets turn lower, those shorts we had, they may have the option price may have depleted in value, but then market starts dropping, and those option prices explode and get higher and higher and higher just with the volatility. So let's take a look at that right now with as you mentioned, the trades, shorts, and we'll take a look at that. I'm going to switch to trade listing. All right. Okay, so you should be seeing the trade listing, and this is on the website also, where the handouts are. I just put that link again for anyone who came in late. The link in the chat window is where the handouts are. Also, the spreadsheet list of trades for the last couple of years. So these are the trades for 2022 over the last couple of months, and through the end. These are closed trades through the end of May. At the end of June, Becky will update this list for closed trades through the end of June. So she updates this at the end of each month. Okay, so let's take a look at this. Last time we had a couple of losses was trades that were valid back in February when markets suddenly turned lower. Okay, so we had a bunch of trades become valid on the long side. All right, with some of the different strategies, and then literally a day or two later, the market just reversed and went the other way, and we had a bunch of sell signals, which are all winning trades. All winning trades. That's why we have to trade short. If you don't take your short trades, I know some people can't literally have trouble thinking short. If you want to call yourself a good trader, you need to be trading long and short, not just one direction. You want to be a good, well-rounded trader, you have to go long and go short. Otherwise, you are a glorified investor, hoping everything goes up. I know people who have contacted me for coaching who have literally made over $1 million going long, and then lost over $1 million when the market went down because they didn't know what they were doing and kept trading the exact same way and lost $1 million that they had made when the market went up. Then they realized what they were doing didn't actually work at all. They only made $1 million because the market went up. It wasn't them. It was the market going up, not their trading skills. So the exact same trading skills they used when the market went up, they thought they took credit for that. Then they tried doing the same thing when the market went down and they lost all their money and then some. So don't think you're a great trader because the market's going up and your account's getting higher. Usually that's what happens when the market goes up. You make money because most people realistically go long. When the markets go down, that's when you know what your trading skills are like, because are you making money when the markets are going lower? That's when you can call yourself a good trader, because you're making money when the markets go lower. Otherwise, you're going to sit there for a couple of months as all your trades that you had wrong go against you, and you'll lose a whole bunch of money with nothing to offset it. So literally a day after we got buy signals, which all ended up being losses, we got sell signals and all ended up being wins. Okay. You're not going to take every trade. That's not realistic. You got to take trades that are within your financial reality, so on and so forth, and within pricing guidelines, and also enough open interest. Some people disregard all of that and just take the trades. That's fine too. You know, some people literally disregard all the rules for pricing, to disregard all the rules for open interest, and they disregard everything and just buy the call or buy the put. That's fine. You know, they may or may not make as much money as some other trades, but they still make money. Okay. But if you are more selective, and we go through that with you one-on-one, how to do that. But yeah, we just went short. And then since from that point on, it's nothing but winning trades to offset those losses. And we had a couple of years ago, one of the guys I was working with, he was so proud of his trading results that after 7 months of trading, that he actually did a presentation with me. And there is a video of him that's online right now of him doing a presentation. And I'm going to show you, I'm going to switch back to, I'll show you the results he shared. It hasn't really changed. This was several years ago, but you take a look what these trades are from May right back through February timeframe, nothing but wins. Okay. And you wonder, how much money do you actually make with these? Because if you're just buying options, they're going to decay in value. So how do I just buy options, buy calls and puts and make any money? How do I do that? How you do that is by consistency. Place 10 to 15 trades a month. Okay, I'm going to switch share. Okay, you should be back on the trading plan now. And I'm going to change the view. All right. This is the spreadsheet put together by the gentleman who I was working with. And he was trading, doing the same type of position management with options. And he did it for 7 months. After 7 months, he shared his results with the group. These are his real account trades, because he was so proud that he had gone from losing a lot of money to making money consistently. That's what he contacted me for. He wanted to make a certain dollar amount, and he was losing money left and right. So what had happened, I've been doing presentations for local option groups since 2007. There were 3 groups locally. I did one up in San Francisco and a couple down in Sunnyvale. And I've been doing those. And so about 7 or 8 years ago, people from within those groups started contacting me for coaching to help them with their trading, since they'd been seeing what I've been doing all these years. It's pretty consistent. So they started contacting me. And this is probably one of the first people that had contacted me about coaching. And he told me a situation, and I worked with him. And we went from him losing money consistently to making money consistently. So if you take a look at what he has here, and if you want a copy of this spreadsheet, like I said, it is online. It's out there in the public domain. If you want me to send you a copy, I can do that also. But it is in the public domain and available. And the percent returns are still current. This is what real numbers look like on option trades. On long trades, he risked approximately $1,000 a trade. He had like $100,000 account, So he was risking about 1% of the account per trade. On short trades with puts, you risk between 500 and 1,000. That was the range for puts, between 500 and 1,000. And on long trades, about 1,000. It'd never be exact, but in that range, in that neighborhood. So these were his percent returns based on the dollar risk. Here he risked is what he paid, and here's what he made. He made more on the second contract. He basically doubled his money on just the second contract alone. Paid $825, sold one contract at the first target, and then at the second target, when he kept trailing his stops, made $1,100 on just the second contract, trailing stops, right? So that we go over also, so you can trail stops and make more money. But he followed the rules pretty well. He documents what he did up here. He did follow the rules pretty well. And you can see the percent returns are shown, what he made on various trades. So 7 months of trading, getting in between 10 and 15 trades a month. What people don't realize is how quickly money adds up. All right. I say risk 2% of the account per trade. He was only doing 1% to get good. He was being conservative. If a trade is meant to be a 3% return, it's a 3% return. You don't try to hold for more and then it goes negative and then it becomes -10, -20, and then a full loss. Whatever the outcome of the trade is meant to be, that is what it was meant to be. We can't dictate to the market what we deserve, what we feel we deserve to get. It doesn't work like that. Whatever the market does, we have to find a way to profit from it. But we don't dictate what the profit is going to be. We don't dictate how the market is going to move, how quickly the market is going to move, or when it's going to move. We trade probabilities. When we take a trade, we know we have an 84% chance or higher that the market we're trading will either move up or down a certain amount within 1 or 2 expiration cycles. That's all we know. But because there are options and pricing varies, we don't know what the final value of that option will be, right? So that's why whatever it's meant to be is what it'll be. So you place your trade, you place your orders, you place your exit orders. And he did a really good job of that, accepting whatever the market gave him. 1.2% return, he took his 1.2% return and kept going on with his life. And it just sort of adds up and 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 adds up. Wow, he had a loss. Big deal. You keep trading, you keep 20, whatever percent return is, you keep doing it, you keep trading. And he was trailing stops. He did a really good job of doing this. And after 7 months, he had a ridiculous 15-to-1 return and made profits of $17,000. If you're risking 2% of the account, that would have been $34,000 or $35,000 with 2% of the account. Okay, but he was learning with 1% account risk. Now, eventually, he had a couple of losses. I know what he came later on, and his 15-to-1 came down from godlike traders back down to more high-end, really good traders with between a 4-to-1 and 5-to-1 return on his money, which means he's making $4 to $5 for every $1 loss. That was what the final number was. He was making $4 to $5 for every $1 lost, not 15-to-1. 15-to-1 is ridiculously high. That's not normal. But the way we trade, just looking back at the last few months, that's the kind of numbers you would have seen in the last few months because there were no losses when you're booking profits. But then when you do have losses, it brings in that return down. But as long as you're consistent, a 3-to-1 to 5-to-1 return is normal and expected over the period of 1 year. That's just normal and expected. A 3-to-1 return or to 5-to-1 return on your money, as long as you're consistent trading. All right. But this is kind of what the returns are you expect. Like I said, you don't tell the market what you want. The market will give you whatever it gives you and you take it. You just have to position yourself to accept those profits. And that's with your orders. You put an order in and your order basically saves you from yourself. You don't make any decisions in real time when to take profit. Your order is in place. Once your order is in, you go live your life. You go to work, you go to school, you go take care of your family, you go on vacation, whatever you do. There's nothing for you to do but place your order, put your trade management in place, and go away. Don't interfere with your trades. There's nothing to do until the first target is hit, and if your trailing stops, then you have to go and manage the remaining option contracts. Until then, you just keep booking profits, and it adds up. It seriously adds up. Your goal is to get in 10 to 15 trades a month. You get in 10 to 15 trades a month, and it's purely a math thing. And it just works so nicely. Do we have any questions at all so far? Any questions on anything with the strategy? And we can go over that on a chart. Or any charts you want to look at. That's an ETF. Stocks is not for stocks. Stocks is a whole different deal. All right, any questions on pricing, anything else? On the handout, I'll take a look at the handout. We put in a couple of examples to trades you can reference. XLB, the material sector. We had one losing trade this year. But here's how we look at stats. One expiration cycle and two expiration cycles to determine which one to buy, what the start stats are. XLB is one of my favorite ones to trade, material sector. Through the life of the ETF, 91% wins with one expiration cycle, and two expiration cycles, 94% wins. Okay. And this is the history of the trades. XLB is one of the most consistent things to trade. The more time you give for the option, obviously the better results you're likely to get, because you're going to hit the target before the option expires. The trade-off there is that you're going to pay more for more time. So if you choose one expiration cycle and you get a win, you will get a higher percentage return, but you will eventually get more losses. If you choose the two expiration cycles, then your account will tend to look more like what I just showed you as the example from the person who did all those trades, but you'll get a lower percentage return on the winning trades. It's a balancing act. Which one fits your personality, account size? A lot of people will choose one expiration cycle because the options are cheaper, or also because they have a smaller account. I know a lot of people, no matter what the trade is, they will take two expiration cycles because they want a higher probability. They'll take a smaller return, but very few losses. So there's XLB with dates you can reference and take a look at it on your own. If you're working with me, I will give you all the charts already preset. You don't have to do anything but pull the charts up. It's already done for you. If you set those up yourself, then you can take a look at these dates to verify that your dates match when they should. So the setup is correct. Email me if you have any questions. IBB. Let's look at IBB. Another big reason we have the stats. One expiration cycle is only 80% wins. Two expiration cycles is 93% wins. If it was 80% wins, we don't touch it. We would never do anything with IBB and only give it one expiration cycle worth of time, because we know historically we need at least two expiration cycles to get to 93%. 80 is too low. Since we don't know what the option price will be at the first target, we always want to make sure we have enough winning trades to offset losing trades. So we want to have at least 5 to 7 wins for every one loss to guarantee we make money. Because you saw some of the wins, there were 2% return, 10% return, 20% return, 30% return. Well, if you have 100% loss, your other wins have to add up to 100% to offset it. Hence, the 85 to 87% wins is what we shoot for, which we usually get, because you have to have enough wins to have enough big enough profits to add up to offset the losses. Futures is different. When we trade futures, every win is between a 40 and 50% return. So we only need 3 losses, excuse me, 2 or 3 wins to offset 1 loss. And with futures, minimum 2 to 3 wins to offset 1 loss. Because that's, we know how much we're going to make is a 40 to 50% return on every winning trade on futures. That's a given. Options, we don't know what the return will be until it actually happens. If you got a gap up, you're going to get a big return. Sometimes it may not be a big return. You don't know because of bid-ask spreads and open interest, volume. So there are much more variables in options. So you don't know what you're going to get until it happens. And sometimes you may get a filled on a trade and it's just wrong. It's just something wrong there. I've had one person, actually more than one person, give an exact situation. They had put options on and there was a gap down. They bought the options for $2.50 something cents. There was a gap. The option should have sold for like $3.75. So they bought the put options for $2.50. There was a gap down. Yay. The option should have sold for $3.75. They sold for 57 cents. And you go like, what? 57 cents was the price they were filled at. Bought them for $2.50, gap down. They should have been sold for $3.75, instead 50 something cents. And he told me what went on, and I told him, you got to talk with the broker, and you had to go investigate it and deal with it. And eventually, after he yelled at them for a couple of days, they gave him a full refund of his money because that trade did not execute properly. That is why, and when I review people's accounts, I did this when I saw people I'm working with, let's review your account every month, but people don't want to do it. It makes a big difference because I want to see all your losses. A lot of people are embarrassed to show me their losses. Sometimes they just mess up. I don't want me to see where they messed up. But we looked at some people's trades from months and months ago, and there were some losses that were unexplainable. Everything should have been a win, and it said there were a bunch of losses. And why were there losses? And we talked to the broker, and they said they can't. It could have been their fault. It could have been a fault on the order entry. It could have been any of various things, but they need to look at it within 30 days. You need to bring it to their attention within 30 days, because within 30 days, they will still have all the forms you filled out with all your entry criteria and exit criteria. That information they still have. If you mess up on your form entry, they have that information. If they messed up, they have that information. But they don't save that for more than about 30 days, since there's so many millions and millions and billions of orders, being placed. They don't keep that information indefinitely. So you got to review your trades every month. Make sure, especially your losses, make sure your executions look correct. So periodically look at your trades. Are they executing correct? Does the pricing seem like it's in the right neighborhood? Was your winning trade, did your winning trade make money? If it didn't make money, why not? It could be a valid reason it didn't make money. That's okay for the time decay. But most of 90-something% of our trades that are profitable, hit the first target, are actually worth more than what you paid, realistically, because they're ETFs, not stocks. So but you always have to review your trades every month, and it's really worth your while when I make the offer to you to let's go over your trades each month to make sure what you're doing looks right, especially your losses. You should have valid losses, not silly losses from mistakes. So as long as you made a mistake and you know about it, just let me know. Okay, that's a mistake. Good. Don't do it again. But if you have an unexplainable loss, that's a problem. That's a problem. All right. So any questions so far? All right. So we did futures a couple of weeks ago, and probably the end of either middle to end of July, we'll probably do our next meetup. It'll be on either futures and or options. We might do both in July, futures and options, the 2 weeks in between. If anyone has an interest in working with me one-on-one on options, we got 2 programs. This is, the cost is $17.50. We have 6 different strategies. I'm going to go through some of them real quick in a separate form, but we have 28 ETFs which we work with, and it's really 6 strategies, not 5. So, but we will go through all the details of how to trade the strategies, how to do the review, and also you have the option, if you want, of me emailing you the valid trades each day, or you can do the review on your own. Helps if you have someone also confirming the trades that you're doing. When you're starting out, I'll help you do that, but eventually, if you want that to continue, just talk to me. If you need help setting up charts, I will give you all the charts needed for both NinjaTrader and for Thinkorswim. So there isn't really much to do on your own except get everything installed. I can work with you on that also. Usually the first time I meet with people is to make sure the charts are all correct. If you do charts on your own, there's a 0 chance that your charts will match mine. Zero chance. Since some of the variables is what are you looking at? The bid? Are you looking at the last price? Are you looking at the ask price? Are you looking at the mid price? What your platform and screen is set to may not be what my platform and screen is set to. So we might be looking at the exact same thing, but with 2 different sets of numbers, because we're looking, you're looking at a bid, I'm looking at the ask. And that's all details that you set in your own platform. But when I hand you everything preset, we all look at the same numbers the same way and come to the same conclusions. So we don't want to eliminate one of those variables right there. If you're in the Bay Area, I can meet with you in person. If you meet you in Santa Clara, you have to road trip to Santa Clara if you want to work with me in person. Otherwise, it's Zoom. You got to commit to 3 to 6 months of trading. If you can't commit to 3 to 6 months of trading, this will not work for you, because you have to see how the wins and losses play out. If you think about it, when I showed you the list before, most of the trades that went against you happened in February. But the last 3 months have been nothing but winning trades being booked. So if all you did was take those losing trades in February and see them all going against you because the market was going down, you have to get through the next few months of taking the short trades also and all the other long trades to see all the numbers play out, because it's a balancing act between wins and losses. It's not just how much money you make or how much money you lose, it's the net result of the wins and losses. So yeah, you're gonna take your losses, but you also have to be having winning trades going on during that time to offset those losses. If you are inadequately funded, this won't work for you. If you got like a $5,000 account and think you're going to trade options, think again. This will not work. Don't even start doing any of these strategies with only $5,000 in your account. It will not work. You need more money, because you always have to. Your minimum risk is going to be about $500, $600 a trade to risk on one trade. That's what you got to think in your mind, and need to be able to put on 10 to 20 trades at any one time. So if you don't have enough money in your account, you cannot do these. If you try to do it with a little bit of capital, you're going to lose what little capital you have, because the first 3 trades you place, or the first 4 trades, they may end up being losing trades, but they don't have enough money to put on new winning trades because your capital's all tied up. And remember, your money might be tied up for a couple of months. So you always have to have enough money to keep placing new trades, regardless of what's happening to existing trades. So, but that's all stuff I go over with you, and then we work out in detail all the variables that involve options, because pricing is not linear. You don't have to, we don't do option analysis. We do our analysis just like we just did on the chart, but you do have to do some basic option Greeks, very basic. You have to know what delta means and how that works. You got to know basic theta, but there's no real analysis. You just have to know, you're buying a 55 or 60 delta option and know what that means. So that if the price moves so much, how much will the option move? So real basic stuff like that, but no detailed option analysis. Anything that requires more than 4th or 5th grade math, I stopped doing a long time ago for trading. I look back at all the stuff I learned from all the spread trading, and I realized those are basically computer college textbooks with all the stuff I was doing. It was like ridiculous. And there's no way I could teach that to people anymore, even because a lot of people I work with, the people who I learned this with were all engineers and scientists, or people with PhDs and master's degrees. The reality is most of the people I work with are not engineers and scientists. They're regular people that want to trade making money. And they're not going to do all this extreme high-end analysis no, that's just not realistic. And as I learned from people who trade their own real money, they don't do that either. It's just so much easier to be simple and do simple math and just keep it real easy. It just works out so much better for me and for all the people who I actually work with. A question: what's a good amount to have in your brokerage account to trade options successfully? Do these particular strategies, $20,000 to $25,000 would be the low end to be comfortable. Could you do it with 15? Sure, in a limited way, but 20 to 25 to be comfortable. You won't still, at 2025, you still can't trade the big boys like S&P or DIA unless volatility goes way down, because buying one call option is going to be $1,500 for one call option. And if you want to keep it at 2% of your account in that neighborhood, that's just way too high. So you'll be able to trade all the other ETFs, but just not SPY and DIA. Maybe Qs, but not SPY and DIA unless volatility goes down. But 20 to 25 is usually low end. And that's the average size account in the US, about 20 grand. So that works really well. If you have a 50 grand account, still 20 to 25. Just because you have the money in the account doesn't mean you're going to use it. You start allocating more capital after you get good. First, you take smaller trades, do that for at least 6 months, get really good at make all your mistakes initially. You will make mistakes. You make all your mistakes with smaller trades, risking maybe 500, 600 bucks a trade. You make all your mistakes there. And as long as you have your stops in, you're good, but make all your mistakes early on. Be consistent with the strategies for at least 3 to 6 months. And talk to me. We go over everything, make everything looking good. And once you're comfortable after 6 months, then start allocating more money. And that's what works really well. So, and after 6 months to a year, you're really good at the strategies, open it up, then get bigger. But you don't put all your money in until you know it works for you and everything is going well. So you start out small and then you add later on. Right. And for people who want both the futures and options, it's $34.95. Anyone doing both, I will take $500 off this price if anyone wants to do both online, and some emails you receive from me and on the meetup, you saw a link to the futures meetup. That webinar for that recorded session will give you a really, really good idea of what to expect from futures. So if you watch that, you'll get a feel for what to expect. If you want to do both, I'll take $500 off of this price for both futures and options. And for if you're just doing options, I will take $100 off this price for $1,650. So it'll be $1,650 for anyone on the meetup. Just have to let me know before this week is over. So by Friday, Saturday, let me know. I take $100 off the price for the options, and I will take $500 if you're doing off if you're going to do both. And let me show you one of the, so you get another feel for what type of stats and we expect win-loss wise. Let's see. Got this here someplace. Okay. Share and stats and share. Okay, what you're looking at right now is a list of ETFs and sectors which we trade. And there's something here for everyone. They're all different prices and price ranges. Some of them you can trade for as little as $100-something a contract, up to the big boys where it's like $1,500, $1,600 a contract during high volatility. DIA has been as high as 2,000 something bucks a contract doing high volatility. So, but it's something here for everyone within their financial reality. So when I say on the document that we can customize a plan for you, that's what I mean. You may have a 15 grand account, which means you are not trading DIA, you're not trading SPY, you're not trading Qs, no matter how high probability the trades are. You're going to be trading something like GDX, you're going to be trading FXI, you're going to be trading EM, you're going to be trading USO, UNG, XLE, XLF, because these are lower priced ETFs that we can work to fit within your account size. The bigger your, as they say, people who have more money will have more opportunities available to them. Same with trading. If you have more money, you will have more things you can trade. Less money, less opportunities. That's okay. We just narrow it down, and you may end up actually working on better. Actually, I know some people have done this too, where they only traded 6 ETFs. We narrowed down 6 ETFs, nothing but 6 ETFs, and just by pure luck of the draw, they went a whole year without a loss, just by trading those 6 ETFs. I know one person traded nothing but the Qs, nothing but QQQ. I asked, "No, do you want more trades?" They're like, "Nope, just want to trade Qs." But we only gonna like 1, maybe 2 trades a month. They're like, they don't care. That's all they want. 1, 2 trades a month. I'm like, okay, great. There's some of the stats for the weekly strategy. We're gonna get to the daily. What you see here, this is not what we looked at today. It's one of the other strategies for the ETF options. If it's in light blue, it means it's 84% or higher for that ETF. So you can see with more time for expiration, we get the higher percentage wins. This is what we track. Anything you see in a rectangular box has been put there by Becky. I do not type anything into rectangular boxes. She does all the stats, updates these daily and weekly, sends me a copy each month with updated stats for everything. This is what we use for trading. So this is how you know what to trade. Like if you're going to be trading XLE, the energy ETF, there's no way we would ever trade only allowing 1 month of time for the option in XLE. This is why so many people have lost money just buying call options. They don't know what they're doing or how much time. They haven't done the research. So you can't just guess arbitrarily which option to buy, because you don't know. We know that we expect to actually, if you do this, you're going to lose money. We know that with 1 expiration cycle or less. We need at least 2 full months of expiration time in option to expect to reach our profit target. This is why we maintain these stats, so we know what to trade. It's not guessing. We trade purely by the numbers. Another strategy, we know with this particular strategy, we know which ETF to trade because the stats are over 84%. D hook, Donchian hook, another Donchian strategy. 97% wins on TLT. This is their interest rate ETF. And one of our Ichimoku strategies. This one is for buying market bottoms. This one is buying markets at the bottom following a decline. This is one of our favorite strategies, which we traded probably the longest than any of the other ones, even longer than Donchians. This is an Ichimoku strategy for buying market bottoms after the market has declined. And it has worked really, really well for us over the years. And we just sort of kept it as part of our quote unquote long-term group of ETFs that strategies which we've kept. And this one is for shorting market tops. This one is for market tops. This strategy will catch every single decline following a rally at the very, very top. If you go all the way back to the stock market crash in '87, to every stock market decline, 2008, you will find that every decline started with this trade signal. This is why we get in with this trade signal, because you never know which the next big move will be. The big drop in, these were the biggest winners in 2020 when everything shut down and the market started dropping in February. This was our biggest winner. These, at the first target where we expected 20 to 30% return, we were getting a 70, 80% return on the first target because of gaps. There were such massive gaps on this trade because we caught the very top of the market and just rode things down. It was ridiculous what the volatility was doing for the profitability, right? So that's an idea for what to expect percentage-wise from some of the different strategies. And I'm going to change the share back. And if you haven't been on our website yet, I'll show you, go to the website real quick. All right, so on the website, homepage, we'll list upcoming meetups here. There's a video link for that futures recording right on the main page. It's a good one to see if you haven't watched the futures yet. If you want to do the combination deal. The valid trades win-loss. We update this each month. So here's the handout. Here's the listing of all the valid option trades. The one that goes back to 2019. Our option trade data actually goes all the way back to 1999 was the earliest, and then a lot of the ETFs started in 2006. So from 2005, 2006 on. So we basically have the full history of that goes way back when, but it's just too much to put here, and so edit down. So we just started doing this so people can see it and take a look over the last few years of data to see it is pretty consistent. So 85, 87% wins over any given number of months. And here is the same video you can watch. And we got some trading questions. And for anyone interested in coaching, we have all the programs here. But I want to go back to the handout for this, but all the programs are here, including the full program with the weekly strategies also. So if you want to visit the website, it's right there. There is something that I want you guys to see. Some of the newer people, this is an article on technical analysis that's really good. And for newer people, I just put the link into the chat window. It's a really good article on technical analysis that explains about us more clearly than I possibly could why we use technical analysis rather than fundamental analysis. It just, everything is there. So if you really want to see why we use technical analysis, this actually explains it really, really, really well on stockcharts.com. So the link is in the data box, excuse me, chat window. All right, and I'm going to go back to the handout. All right, so does anyone have any questions and anything at all, and any current strategies, what's going on? Those of you already trading stuff with me, any questions on any of the strategies? Are you good to go? Otherwise, we're gonna wrap it up for today, and we'll resume probably the second week of July for our next meetup, probably on futures, but not till the second week of July. We've got a holiday the first weekend and stuff. So any questions, any questions, concerns, anything you've seen, anything you wondered about? And you can always email me, call me, and I'm pretty readily available. And if you want to work with me on, you have the pricing. You want to do both programs, $34.95 minus 500, and for just options only, $17.50 minus 100. And I'm pretty available in 2-hour windows and 2-hour segments to work with you throughout the week. Mornings, some mornings, mostly afternoons and evenings, and Sundays. Sundays, I have a lot of time on Sundays for 2-hour sessions and one-on-one in person or via Zoom. All right. Unless you have any questions, we'll go ahead and wrap it up, and we'll resume in July. All right, I don't see any questions. So until next month, and I'll make the recording available a little bit later on so for you to play back. See y'all later.